Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, welcome back to Big Money Real Estate. I'm Elise Glink. Here's your daily update. So last week, I interviewed the CEO of a private money lender, also known in some cases as a hard money lender, but not as a Tony Soprano. And that company underwrites higher interest loans for real estate investors who are either flipping or renting properties and for whom current lending standards would prevent them from being able to buy and accumulate more investment properties. But what if you are looking to buy a home you're going to live in and you don't qualify for regular lending standards for whatever reason? Well, today's show, I've got Michael Slavin. He's the founder and CEO of Privlo. This is another private money lender, but their target consumer is the average home buyer who can't get a bank to lend them money. Maybe they've got a thin file, maybe they're self-employed, maybe they've just opened up for business here in the state of Illinois. Hey, Michael, welcome to Big Money Real Estate.
Thank you. Thank you.
It's nice to have you. Who does Privlo? Let's start with, tell us a little bit about Privlo, who you cater to, and why you started this company.
Sure. So Privlo is a company. We're categorized as a marketplace lender. So it's this new breed of lenders, ones that I think the consumers would be more familiar with. If they are familiar, are groups like Lending Club that are focused on personal loans, On Debt Capital focused on small business loans, and Privlo is focused actually on residential home loans. So we're a marketplace lender, meaning that we're taking private capital and we're putting it to work using data science to really serve an underserved borrower niche that's not typically addressed by typical bank underwriting models.
Why is it so hard for self-employed people to get loans today?
So for this particular group, essentially they have, let's say, more opaque income than typical individuals. They're not just a W-2 employee with a straightforward income on an annual basis. They might take deductions for tax purposes. They might have spiky income because they have a seasonally driven business. In Chicago, for instance, like somebody who owns a snow removal business, they have some big months, especially these last couple of years, and then they have some slow months when there's no snow falling.
All right, so one of the things that used to happen is you would have stated income loans with regular banks. They would, for a higher interest rate, allow you to just say whatever it was you thought you earned, and they wouldn't require any documentation. Now that's gone away with the housing crisis, and it sounds to me like Privlo has kind of stepped into that space to try and make loans to these people who would otherwise have maybe gotten a loan from a big bank using a stated income loan.
Mm-hmm. That's correct. And we do extend that program, but we're taking the next step. So what's happening behind the scenes I'd say the credit officer that we've hired and the specialists we have in-house, we've taken a new approach in mortgage, where actually our credit people all come from the consumer lending world. So they're really good at analyzing consumer and their bank statements over time. So not only do we want to hear what a borrower makes per month, we're actually going to verify that income through third-party sources. So essentially deposits into their bank account month over month to make sure that we can, we can verify that they're actually making the money they're stating that they're making, which did not happen during the crisis.
Right. So one of the things that's pretty interesting is when over the last week, I was at a journalism conference, and it used to be that all of these business journalists worked for Bloomberg or the New York Times or the Wall Street Journal, Market Watch, and now half the people in the audience have lost their jobs and they're working on their own. They're maybe making almost as much as they were before, but to your point, they're independent, and independent workers overall in the U.S. grew to almost 18 million last year. That was up 12.5% over the previous year. So Privlo, which doing the research for the show, we found began as a peer-to-peer lender. Now you're more a direct lender or a retail lender, as we would call it. Is it your belief that after the 2008 crisis and all of these different people lost their jobs and are now kind of figuring it out as we're coming out of this great recession, they've got income, but they just don't qualify? Is this just so underserved and traditional lenders are hamstrung and they just can't get to these people?
Sure. So it's pretty interesting. There's a couple of things happening, or a few market forces. One is, you're right, where the 2008 downturn actually resulted in a lot of folks being laid off. And what's happened is corporations have become profitable again, but they learned from lessons from the past. They want to be able to right-size their workforce quickly. And so if you bring on contractors, you can size up a workforce, but you can also size it down very, very quickly without all the ramifications of traditional employees. And so that's one factor taking place. Also, what you have is a big shift in professionals. So architects, accountants, attorneys, et cetera. We're seeing a lot of conversion actually over to a contract basis for tax purposes typically. So they can actually take deductions and work on their own and really call their own schedule. And we're also seeing that to a further extent. We're going to see that in coming years with the millennials. Millennials like a more flexible work schedule, also fueled by the on-demand economy, which you see in companies like Uber and other companies where essentially a consumer can click a button on a mobile phone and get services, whether it's TaskRabbit, somebody to deliver your mail, shovel the snow on your walk, or Uber whenever you need a ride. So we're seeing all these demographic shifts take place currently, and we're happy to address them. They also result in very uneven income or very unpredictable income by bank standards.
Right, of course they do. So where do you see this business growing? I know you're in a dozen markets and you're doing a lot here in Illinois. Where do you see the demand coming from, and how big do you think this is going to get over the next 2 years?
Sure. It's because of the growth story we just talked about a moment ago. It's by some accounts, I know Forbes magazine feels that over 29% of the workforce in today's world and over 50% by 2019 will actually have some component of self-employment or some component of additional income through non-traditional sources. And so as far as region, what we're doing in our strategy is essentially if you stick to the coasts, you'll get the most is the term in lending or any business for that matter. And you can imagine that 70% of the population around the world lives along the coast. So the states that we're going to hit hard, or we have hit hard at the beginning, are coastal states, and we move inland. There are a few exceptions like Texas, which is a great growth story for tax treatment purposes and baby boomers actually retiring to a warm state. But other than that, we're really focused on the coast, and then we'll move inland in the next 2 years.
Okay, and Illinois is a perfect place for this. Chicago, well, the state of Illinois is, or I should say the city of Chicago, I learned this past week at this journalism conference from Mayor Emanuel, Chicago is number 4 of the 75 largest cities in the world for tech businesses and technology, which is really astonishing. So to your point, new businesses and startups are rapidly expanding here. Your perspective is that more of those people won't be able to qualify for traditional loans, at least not in the next few years. I just want to get back to sort of costs. How are you guys making this work? How much money have you raised for it? And I understand you also retain a portion of ownership on every loan made. Why don't you quickly describe those please?
Sure. So it is a really, I think, challenging situation to actually underwrite these borrowers effectively at scale. That's why we do have consumer credit scientists in mass that we've actually hired onto the company so we can digest financials quickly. And all this has been completely automated, which is a terribly challenging problem. And that's why you're not seeing this happen from traditional industry, because it takes a lot of forward investment. And to be able to do that, you need to go out to venture capitalists and convince them that you have an idea that's worth merit of actually building the technology around and that you'll have returns on that investment down the road. And so we've been lucky enough to get some of the best venture capitalists in the world who focus on fintech, which our category is called, to invest in our platform. And so we've actually raised over $10 million to date and are currently focused on a new round as we speak. And that money, of course, translates into automated technology so we can ingest bank statements quickly, seamlessly, actually analyze credit behaviors of consumers over time, which nobody else is doing in the industry. So again, it's a really daunting challenge. It's a lot of fun. And we're happy to be on top of it every single day, extending this technology to consumers to make a better consumer experience and to reduce transaction friction, meaning they don't have to put as much work in. We do all the hard thinking to get to a yes quickly.
But who's underwriting the paper? So if you're using the 10 million that you're for technology, who's actually underwriting the paper, and where are you reselling that loan?
Sure. So as far as who underwrites, it's pretty interesting. You look at the human brain. In the processing capacity we still hold, it outruns a computer every single day of the week. I mean, we're just so complex as creatures, and our thought processes are so lightning quick. But what you can do is augment that human thought process with technology. So it's essentially letting computers do what they do best and the human do what they do best. And so there are certain red flags that come up in any particular transaction that could raise a red flag for, say, money laundering, for instance. And a human's going to be able to pick that up, but not typically a computer. So we actually, it's a dual underwrite, if you call it that, where we have an automated process. A human quickly checks the process, and we actually, sell the loans on a one-by-one basis to private investors. And what happens at that stage, we actually retain a portion of the ownership or income stream of every loan. And when the loans go to, say, a securitization or they're held on a balance sheet, we'll retain a portion of ownership, either through an equity stake, an equity stake in any case.
So who is the servicer for these loans?
And so we're actually the servicer of record, but we have a sub-servicer that's in place. And those sub-servicers are typically investor-driven, meaning that the hedge funds we work with want a certain servicer they've worked with in the past. And so we have a few servicers we work with.
And what are the costs to consumers typically? What interest rates are you offering?
That's a great question. So in this industry, it's somewhat of a new space where before we got involved at scale, you had, say, traditional loan rates, which everybody's pretty aware of. You can check those on bankrate.com on a daily basis. They hover around, let's say, 3.5% to 4% in today's world. And then on the other end of the spectrum, before we entered this scene, you had hard money lenders that would start at typically 9% and up. And so our range today that we're hitting is we have a 5.25% start rate, and we go up to just below 10%. Even though we never get to 10%, those are pretty extreme cases. It's really hard for people to actually have that bad a credit, and usually it's pretty risky credit.
So are you pulling FICO scores, but because people don't have the 2 years of self-employment data like P&Ls and actual tax returns, they don't qualify for regular loans, so you're actually qualifying them based on a FICO score?
No, FICO score helps triangulate and actually price risk, and we go much further beyond just a FICO score. Where that works a lot for, say, credit card issuance in much smaller dollar transactions, we're actually interested in the entire credit history of an individual. So we really lend upon a spectrum of borrowers. On one end, it's just, say a borrower has a really good FICO score who just has really uneven income or really opaque income like a business owner because they take a lot of deductions for tax purposes. And so it's not so FICO score driven on that end of the spectrum. On the other end of the spectrum, who we do serve, who does have a damaged FICO, is, say, a borrower who had a one-time bad life event. That could be a medical bankruptcy, foreclosure, short sale, et cetera. So essentially you look at their credit history over time, they're really good credit, they're always paying their bills on time, but they had one life event that really resulted in some bad circumstances. So they lost their job or they went through a divorce. And so we're able to isolate those events and say, okay, this person's been a great credit for the last 20 years, but they had a really tough year that was outside of their control. And so that's where we're able to actually size the loan for them and price the risk appropriately and still give them a competitive rate.
It's terrific. Well, we really appreciate your time today, Michael. Michael Slavin is the founder and CEO of Privlo. We'll check back in with you in 6 months or so and see how it's going.
That sounds great. We're excited to get to Illinois.
All right. Thank you for watching this episode of Big Money Real Estate. Please send me your real estate investing and personal finance questions on Twitter and Facebook. Be sure to share this video on all your social media. Until next time, I'm Elise Kling.